Let's talk about the history of mathematics in accounting. An account is a financial record of a firm's transactions. Accounting is defined as the recording and reckoning of numbers. From ancient uses of recording the growth of crops, herbs and livestock, more modernised uses of enabling organisations to communicate with shareholders, accounting has always played an important role in society. The earliest forms of accounting recorded took place before money was invented. Ancient transactions recorded on clay tablets from as early as 3300 BC been discovered in parts of Egypt and Mesopotamia. In 1970, Danish Shmand Bassarat figured that the abstract marks on clay cuneiform tablets matched the shape tokens believed to have been used in correspondence counting. In simple terms, for each token exchanged, a stylized picture of a token representing the exchanged commodity would be recorded on a tablet. These clay tablets, adorned with abstract writing, therefore provide the first archaeological evidence that written accounts and contracts existed in bartering times. The discovery was followed by the development of a verification device known as the bulla, a clay ball which detailed payment obligations on the outside and contained corresponding tokens on the inside. A further invitation was the transition from drawing impressions for each item exchanged, for example drawing 5 sheep impressions for exchanging 5 sheep, to having an abstract symbol for different numbers. Agrarians of society used this primitive accounting system to determine whether there was a crop, livestock or animal shortage or surplus by calculating the difference between quantity supplied and quantity demanded at the end of seasonal harvesting periods. First accountants were employed around 300 BC in Iran, and tokens and bookkeeping scripts were discovered. Renaissance developments. Until the 13th century, single entry bookkeeping was standard practice, and old ledgers consisted of descriptive entries. This meant bookkeepers had to decide whether to add or subtract amounts when calculating something as simple as monthly profit or loss. This method was insufficient and time-consuming at a time when merchants depended on bookkeeping to oversee multiple transactions financed by bank loans. Furthermore, the single-entry system did not guarantee an effective internal control system, income determination, asset security, and separation of private and business property ownership. Modern accounting started in the Renaissance following the introduction of Arabic numbers and double-entry bookkeeping. An Eastern mathematician named Al-Khwarizmi published the first book containing algebra, the compendious book on calculation by completion and balancing. This book established a new decimal system of numeric ideograms 0 to 9 based on additive angles, simple arithmetic, and handwritten notations of the abacus. Al-Khwarizmi's book also introduced plus and minus symbols and distinguished between real accounts, which form the basis of the accounting equation, total assets equals total liabilities plus total equity, nominal accounts, which reflected the owner's increment in wealth as well as net income. Furthermore, Al-Khwarizmi stated that algebraic manipulations on the left-hand and right-hand sides of an equals sign must balance. This theory formed the algebraic equivalent of double entry's bookkeeping equation for error control. In 1458, Benedetto Cotrugli established the double entry bookkeeping system. In 1494, Luca Pacioli first described how this system was used by Venetian merchants in his Summa de Arithmetica Geometrica Proportioni e Proportionalita. In simple terms, double entry bookkeeping is a method of recording transactions where every accounting entry has an opposite corresponding entry in a different account. In Venetian bookkeeping, all creditors appear on the right hand side of the ledger and all debtors at the left, because if you make someone a creditor, you must make someone else a debtor. Pacioli's works revolutionised modern accounting to minimise fraud, errors, misappropriation and pilfering of assets, and maximise the accuracy and reliability of accounts, forming the basis of profit and loss accounts and the balance sheet. Rules and prepayments. The growth of corporations and capital markets in the 18th century transformed bookkeeping into the practice of accounting. Till the early 19th century, accountants relied on the cash base of accounting. Transactions were only recorded when cash changed hands. This meant that revenue was only recognised when cash was received, and expenses were only recorded when cash was paid out. This made it difficult to determine a company's financial position. Accounts payable and accounts receivable would only be recognised as the cash payments were made. However, accrual accounting is a method for recording transactions where revenue is recognised as it is earned and expenses are recorded as they are incurred, which includes accruals and prepayments. Although it was uncommon for public sector branches to use accrual accounting, many local councils did so after 1974 reforms. NHS reforms of the 1990s marked the complete public sector transition from cash-based accounting to accrual accounting. Scandals and reform. Fast forward to 2001, a major accounting accounting scandal was performed by the former energy giant Enron. Enron used mark-to-market accounting to claim projected profits on its books when profits were yet to be earned, and would transfer assets yielding less revenue than expected to an off-the-books corporation, causing the loss to go unreported. Enron also transferred some of its rapidly rising stock to special purpose vehicles in return for cash. Special purpose vehicles would then use this stock to hedge assets listed on Enron's balance sheet, concealing their liabilities. When this scandal was uncovered, Enron's share price collapsed. The scandal, amongst others, led to a series of new laws being passed, including the Sarbanes-Oxley Act, which aimed to improve auditing and public disclosure in response to several accounting scandals in the early 2000s. The advent of spreadsheets and cheap and accessible accounting software, auditing also moved away from its previous emphasis on transaction testing to a far more rigorous review approach, where inconsistencies in numerical trends in detailed lines of account provided a much more focused basis for areas of investigation.